what better way to do that than an entire panel telling stories, like actual things from the trenches, obviously principles based. We hope you take some actionable advice away from here, but rather than talking theory, here's why you should do it this way, make it very clear, here's why you should do it this way, because your deal will blow up spectacularly like Joe, insert story. Feel free to ask questions. So very quickly, I won't do full bios. Maybe I'll just give each of you a second to introduce yourselves. But just to round out the panel, service provider focused panel, mostly only because we have the most war stories. I'm obviously from SMB Law Group on the legal side. As you all saw last night, we've done pushing 400 deals now, which has generated a lot of great stories, good and bad, on the legal side. So immediately to my left is Jackie Hirsch. Jackie, if you want to introduce yourself.
Hi, Jackie Hirsch, Crown Atlantic. I've been selling companies for 28 years almost now, so since 1998, and sold about 400 companies over that time. I have all sorts of stories, and it's all like really personal. I have my own shop. I also sell on the Dealonomy platform. I'm an LP on a number of searcher deals. I also invest in funds. I'm a Minds Capital investor. I do some venture and some other stuff. And it's all like, I was telling some of the guys earlier, like, I didn't inherit it or marry it. I didn't win it. It's all money that, I've made over time, and I started with nothing. So I really relate to a lot of my sellers. I'm out of Orlando, Florida, but I do sell companies nationally. So thank you for having me.
And then to Jackie's left is John Hannum. John, maybe take a second.
Sure. John Hannum. I currently have PPS Solutions. We're sponsoring the coffee, so make sure you get the good lattes. My background is in corporate finance. I was CFO of some companies that did roll-up strategy, took a few companies public, been with some private equity, not private equity, traded companies back and forth, been sold and bought a lot of times. So on the corporate side, I thought I would do that forever until I realized that there was this thing called a fractional CFO. Started a fractional CFO firm that led me ultimately to diligence. I couldn't find anybody to do kind of small deal diligence. And here we are. My firms do fractional CFO work, diligence work, quality of earnings specifically, and also modeling and support through the transactions. We're trying to make sure that the loan actually gets processed. I talk with a lot of the banks directly. And then over the last couple of years, I've bought a few CPA firms. So now I'm not necessarily a searcher. There's only a couple sites for CPA firms, but I've been through both sides of that now myself, buying and selling companies with other people's money, and now my house goes away if they're not successful. So I know how it feels to be on both sides of the deal.
Real skin in the game.
Yeah, that's my war story.
I'm actually realizing as I'm sitting here with the clicker, I both can't see the screen. Oh. And you probably know the slides better than anyone. Yes. So I'm gonna give you control.
Excellent.
So yeah, why don't you kick us off?
Yeah. So we in thinking about a theme and realizing kind of the stories most involve some level of chaos, right? Chaos creates good stories. Well-ordered, organized acquisition would be a pretty boring topic. So
mine ran steady as clockwork, right, Jackie? Yeah. Well.
So we kind of coalesce around the idea of having chaos as the main theme, and chaos from different places. So I was a broker and a lawyer and a CFO. This is not the beginning of a joke.
We walked into a bar.
Yeah, we did. But so chaos, just comes out of everywhere. It comes from a lot of places, and it's usually not contained. So we kind of thought we would share our stories based on the types of chaos. Specifically, Jackie will, I think, address more of the human chaos in the focus. Every deal is a relationship. It's a marriage of some type, and short or long. I'll kind of talk about the finance focus. Bad financials are never actually just bad financials. There's always other components associated with that. And of course, trusting somebody is great, having a great relationship, but you got to do your diligence on the numbers. And then Kevin can talk about the deal focus and making sure you're really covered for all of the chaos that can come out of your deal. So that's our focus. I'll let you guys tell stories.
Nice. Okay, so human chaos. So first,
Jackie's nickname.
Yes. Thank you. Yes. I always want people to remember that the deals are made up of people. It's not just numbers. It's really people, and people are messy. And there's nothing wrong with that. It's just life. And there was a deal I did last year that I mean, there were nights I didn't sleep, like, over this deal, because it was so unbelievably involved. It started out in February when it hit the market. We put it under LOI pretty fast. We had a number of people. I kept a very small process. It was not really out there on the market, although Girdley had it on his podcast just because I sent him my teaser because it was so good, and they couldn't figure out what it was. It was a natural products distribution company, and so they're like, is this weed? Like, they couldn't figure out what it was. But anyway, it was not weed. So the seller was getting a divorce. Chaos number one, right? You have that. You have stuff like, then we had a broken deal by July, and you had another buyer swoop in, and you've got the former buyers like threatening you physically and legally. Like, I'm going to come to your office. I'm like, that's why I keep it locked. So, you know, and I go to a physical office, even though my office is like a half mile from my house. Like, I have to leave my house. Otherwise, I would just like work out and hang out and eat and like clean stuff. And like, I have to leave. So, this deal, there's a divorce at some point, you know, then we have a broken deal. We had landlord difficulties, 3 different locations. One of the buildings was owned by 2 partners, unrelated, who died during the ownership of the business. And then it went to 7 heirs. And the heirs were like nephews, cousins, and second wives, all unrelated. Okay, messy. And they all think, oh, we can just kick out the business and then we can just sell this building for 10 million. And that wasn't the case. So you had that, and then you had another location where they were trying to sell the building and didn't want to renew. And then you had a third location where the guy owns a REIT and he's on his yacht all the time, like all the time. And so I would do different things to like try and manage that situation. And then you have an absentee owner. So people want this absentee owner, but the problem is the absentee owner doesn't know where anything is. They don't have passwords sometimes. They can't remember logins. They don't track metrics. Their systems don't jive together. And they're like, oh, my bookkeeper has it. Well, that was fine until the bookkeeper was sleeping with head of procurement problem. So the bookkeeper was fired because like they decided they needed procurement more. Also, like, just problem that involved a green card. Okay. And then there was another green card situation. Everybody was legal, but like there was just issues. And then we had a non-Harvard attorney and a Harvard attorney. And just so you know, that basically means that the non-Harvard attorney hates the Harvard attorney just by the fact that they breathe. There were no injustices served. Nothing happened. And so I was mediating all these relationships like throughout this time. And like, right, I have a seller who's kind of in difficulty with the divorce. You're managing the landlord relationships. You're managing due diligence. You're managing all of these difficulties. And the buyer was fine for the most part until one of his family members was murdered. And so they disappeared for 10 days, rightfully so. Like, I mean, he told me, he's like, I gotta take some time off. I'm like, you got it. And so I sent him this book, and so this book called Letting Go by Dr. David Hawkins, I think that should be like a required reading for school instead of all sorts of other BS that they assign, but that's a whole other thing. But, you know, just trying to support all of these people through life situations and get them through to the finish line and manage their internal discussion. So in this time also people were taking vacation. We had Christmas, we had Thanksgiving, and, you know, then we didn't find a new bookkeeper because the buyer was like, listen, I'll just put my own people in. So why am I telling you all of this? And it's unusual, this amount of drama on the deal, like unusual. I want, when you're buying a company or when it's your company, I want you to always think about what the other party's dealing with when you can, because that will get you a long way. And sometimes something will happen, like they're like, I can't make that meeting. And they're like, they need to be at that meeting. Maybe just take a step back and think, okay, there might be something big happening in their life that they're dealing with and they can't be at that meeting or they can't be on time. And deals always take longer than you think. Like Jared and I were talking earlier, and Jared is like a stealth SBA lender, and as well as Alan. So Jared and I were talking about this deal where like he was able to get it done so fast because the deal fell apart, and then he got in on it and it was all put together, right? That's when you get a fast deal. You don't get the fast deal the first time when they're like squeezing out, blood from a stone, trying to like get a document. So I want you to think about like chaos and human chaos and not be disappointed by it, but really just kind of let it pass through you and digest it and be supportive as much as you can without like losing your mind, because it is tricky. And I do have some tips later, but that's my portion on that deal, which I'll answer questions on later. And it did get done.
And how many are first-time searchers here that haven't acquired? There are a handful of you. How many of you are searching full-time? One of you. Okay. Your sellers are selling part-time of the part-time of the part-time of the part-time, right? Like they're working 50 to 80 hours a week in the business still, which underscores the human element, because even if none of that other shit's going on, you're asking for a laundry list of 78 documents in the next 48 hours for your quality of earnings is literally the last thing they want to be doing, even though they really want to be selling the business, right? And I see that psychology butting heads all the time. Like, this seller just doesn't even care about, he or she is really, 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 really busy. And especially if you're searching full-time, you're like, I sent that email 3 hours ago and he hasn't responded yet, because he's plunging the toilet that clogged up in the office, right? So
I mean, you want that sellers actually be operating the business. If they're getting the documents to you and that's their primary focus, they're checked out on the way out.
It's a hard balance because you need it to get the deal done, but you don't want a checked out seller for sure. Yeah,
keep running the business. Oh, that's okay. Finance focus. There's no such thing as finance focus. Everything is caused by human chaos. So Jackie's story is pretty much I guarantee that company had some chaos in their books. But I mean, there's really not a deal that, when you look at a company that has clean books, you know that the rest of their processes and systems are good, right? You can, if they have clean books, you can rely on the fact that there's something going on there. They don't happen by accident. No good accounting happens by accident. So, everything that happens within the business winds up in the books, so you can see the story through the financials of everything you want to know. I have a few different stories. I've got a fun story with murder and
I love the story.
Yeah, all that as well. But really, it starts with just being prepared. And so, one of the few times I've gotten called in on the sell side was a broker in New York trying to get rid of an HVAC company that really wasn't making any money. Family of like 8 people running it, and they were all treating it like a personal piggy bank. So the ad backs were massive, and they had several CPAs. They didn't want to pay more than $500 for anything, so they had several CPAs over 4 years try and figure out and put the books together in a different way. Everybody had made adjustments to retained earnings differently, so it was a mess. And I looked at it and I said, I gave them my price, and they said no, we'll pay half that, and we parted ways. Ultimately, 3 months later, they called back and we did the deal, and they had an unreasonable expectation for a price just based on the number of ad backs. But still, they realized that this mess, they were cheapskates, and that's what happens, right? If we don't invest in what we're doing to run the company, bad financials pop out of that. The thing that actually got me into this business, I always thought I'd remain a corporate CFO and we'd get the stock options and ring the bell at the NASDAQ and get the cheap champagne and do it again. And what brought me out, it was March of 2020. I had just left a company that I took public in 2018, and very happily, it's one of the best departures I've enjoyed, but it was March 7th that I finished consulting with them and went to the theater that day for the first time. We saw people for the last time in a year or so. But all the new jobs, all the things I was thinking about doing just kind of evaporated. And when a friend called and said, I need you to help this small company, I said, I have no reason to say no. I would have said, okay, a $13 million company that does not sound interesting to me at all. Don't sign me up. Had nothing to do that Tuesday. So I met with them, and literally it kind of changed my life. It changed my focus of things. what I realized from this crazy story is that small business does things that they absolutely should not. Like, they make decisions because they just feel this way or that way. They just, let's write a $2 million check because I feel like it today.
So true.
And it's
So
true. Gut gets you. I mean, part of that, it works, right? Because guts of an entrepreneur, you got to trust your gut. But if you add finance to that, it's better. You can actually be certain of what you're looking at. So it was kind of a partnership dispute, but it had been going on for a number of years. One guy invented the product, and it was, it was his enigma and his persona that was the company. The other two kind of organized it in early times, but they got kicked out of the business because they were trying to take it. This guy had been running it, not really a good operator, had been running it for a few years. His personal life was kind of a disaster as well. And so low credit score, constant kind of cash issues, couldn't really buy out the other two partners, but they still owned, 66% of the business. Not a controlling interest because the management agreement was pretty steady, that 67% was required to make any changes to the business, which was great. But still, he couldn't afford to buy the business. They were friends from high school. They had gotten such animus with each other that they were making death threats on Instagram. So part of the court record is literally Instagram posts where people were making up songs about running over each other with cars. And so here I walk in with my finance hat and I'm going to fix it. Really, it's a cultural problem, right? They had let things get out of control. They'd made terrible decisions along the way. And the only way out was a buyout, right? Somebody had to buy somebody out, and it couldn't be the people that didn't have the name. And if they lost the founder, it would be bad for the image of the company. And the founder didn't have the it's very difficult to get. Jared did the deal. It worked. A very unconventional deal, but we made it work. It took 2 years of kind of working with this company and making sure that they understood what it was. We went to mediation. We went to almost therapy through the whole process, and that was really quite useful. But chaos comes from everywhere, right? We finally negotiated an actual settlement. We got the SBA loan in place. Everybody got paid, the correct amount, and now there's one owner. The company is hopefully doing better and more organized.
Love it.
Let's.
I don't know why I'm doing this when there's another chair over here. Much better. I put some bullets up here, but really just a couple of stories. I mean, on the legal side, obviously, what's my role as a lawyer to a deal? It's to identify risk, right? Very, very similar to the financial side, right? Identifying risk. And interestingly, I'm probably going to regret saying this. A lot of the risks that we identify end up not being necessarily legal risks. They're still financial related, for example. But you still have to understand how to account for those in your transaction, right? Legal risks, I'm always telling clients, they almost never tank deals, right? If your earnings are off, if John runs a quality of earnings and determines SDE's actually 800,000, not $1 million on 4 turns of EBITDA, you can't overpay $800,000 for the deal. You've got to renegotiate the purchase price, and you've got a high likelihood of that deal falling apart. It's a lot different with legal risk, that we may uncover. Oh, we discovered this in the legal record. Like, we'll add a contract provision, and it's not a big deal. What we're always looking out for are the red flags, right? And this is a true story. I'm not making this up. I had a deal a year and a half ago. As I recall correctly, I may be slightly off on the numbers, but it was roughly a $1.5 million EBITDA business, right? Significant purchase price. It was going to be SBA-financed, etc. And I got a call 2 weeks after engagement where the client says, so I'm really struggling to figure out, I finally got a hold of the tax returns, and the tax returns show that the business is broken even for the past 3 years. Now, that should be an immediate red flag, okay? There's always going to be some discrepancy between your financial statements and your tax returns. different things you do, and there is almost never $1.5 million difference between $1 million profit and breaking even. And so he goes and does a little digging and comes back and tells me, okay, I figured out what it is. The seller's been accounting incorrectly. And I was like, okay, tell me more. They had been spending $300,000 a year in Google, like, paid social media ads. And a whole bunch of things started connecting in my mind, because one of the weird things about this business was that we were buying 7 entities, all selling the same products, but into different channels. They had an entity that sold on Amazon. They had an entity that was direct to consumer on their website. They had an entity that sold to, whatever. And I'm just like, is this guy an idiot? Like, you don't have to do that. One company can sell to 7 different channels. It turns out that what he was accidentally doing was taking $300,000 of marketing and advertising spend and deducting it against 7 entities, all $350,000. Because the benefit of the $350,000 of marketing spend, it equally benefited all 7 entities. So he was spending $300,000 a year in marketing and deducting $1.5 million. And so my seller's asking me, like, how do we contract around, like, what can we put in the indemnity to protect myself? What do you think my answer was in that situation, right? You can't contract around fraud, okay? And that's the biggest takeaway on the legal side is watch for the red flags, right? There's a difference between legal, like, there's a difference between something happened that exposes me to risk legally and inheriting fraud, right? And the lesson there is, if someone is willing to defraud the US government under penalty of perjury, 110% of the time they are willing to defraud you, right? Yeah. So if you have some contractual issue or some historical organizational thing wasn't documented correctly, you paperwork around that. You add a provision to the agreement. You clean it up before closing, right? If someone's committing fraud against a third party, 1,000% of the time, you see that inflation? I just went from 110% to 1,000. 1,000% of the time they are defrauding you. And you cannot do that deal. Sure enough, this deal tanked. Let me temper that. And I debated whether or not to share this, but I know he's comfortable with it because he's very open publicly and has a social media channel about it. I bought a business from someone who I discovered had been convicted of fraud 20 years ago. And that was a big part of my diligence process, as you could imagine, and it was probably the most uncomfortable conversation of my life, sitting face to face with someone and saying, tell me about your prison sentence for fraud, right? What was the difference, right? He had a story. It was 20 years ago. He was very open about it. He wasn't hiding it. He literally has a social media channel where he talked about his battles with addiction while he was on Wall Street and how it landed him in prison and what he did to but we were able to vet it and confront it head on. So it doesn't necessarily have to be a deal killer in the right scenario, right? If he had been convicted of fraud 6 months ago for something in this business, you are an idiot to close on that business, right? If you discover that he's deducting $1 of marketing spend 7 times across 7 entities, you're an idiot to close on that business. You're not an idiot to learn a story, to understand what happened, and then de-risk as much as you can if there is an appropriate answer to the story, right? So those are my 2 initial war stories to talk through the legal focus. Be really, really smart as the final decision maker about what level of risk you're willing to take. And when someone is indirectly screaming at you who they are, just believe them, right? You have to believe what you're seeing, and no amount of contracting around that level of wrongdoing is ever going to save you, especially when it involves taxes. So
So common though. I mean, the
Unbelievably
number,
common.
Yeah.
like when you look for a company, you're going to get the SDE, you're going to get the SIM, and it's going to have the SDE in there. There's a number called add backs, and it's just a magic number. SDE is a magic made up number. Add backs, when you look at the list, add backs as a percentage of your SDE, it's usually like 100%, right? Because they run the companies like they run their
Right.
it's ingrained with their personal life.
Yeah.
I had a construction company. He's in California, but the guy lived in Florida, who was buying jet skis in Florida, and that was cost of goods. He runs a construction company. It's not cost of goods. There's no possible way. Like maybe if you're a real estate agent and he was doing home tours on jet skis, maybe, I don't know. But tax fraud, $35,000 worth of tax fraud, relatively small what we see, but still, it's.
And those are the scenarios where the judgment calls come in, right? The wife's Lexus being deducted against the business.
Correct.
You can't do that. That's wrong, right? Does that rise to the level of this guy's a criminal and I'm not going to do this deal? Probably not, right? But that's a lot different in terms of degree, and there's a lot of judgment that goes into that.
And taking on the risk is a little different too, right? Because they're taking on a risk in an asset sale versus a stock sale, right? You're not inheriting that tax fraud and that tax liability, depending on how much you want that person involved in the business post close. You don't necessarily want somebody involved who doesn't have integrity.
Yeah. So
and
that's the kicker that gets me particularly. This always comes up with tax fraud, guys. It's always tax fraud. I'm doing an asset deal, right? So as long as I do it correctly, I'm insulated. And that's why I always come back to, if they're that blatantly defrauding under the penalty of perjury, I can go to prison level of fraud. Like there's 100% 10 other things that you don't know about. That's just the one you know about because it happened to be in a tax return.
And you got a good QOV.
And a good QOV.
Definitely. Although I think John's bikini realtor story in Florida sounds strange. And I think I would not recommend selling homes that way. I don't ever sell homes. I'm not a realtor, but I just think it was funny. Maybe they just do it in California.
I was trying to think of a scenario where jet skis would be a business expense.
No.
Except for just, obviously renting jet skis.
So, let's talk about add backs because I see that all the time, on my end. And there was a construction company that we were dealing with, and they were a roofing contractor. Mm-hmm. And they built a boathouse for their North Carolina property. And a boathouse, like it was 2 stories. There was a room and a bathroom like on the water, and then the boat went under. It was amazing. But it was like $250,000, like in the cost of goods, deducted. And we're like, we can't add that back. They're like, sure you can. I'm like, try and pull out all of the cost of goods. Like you just can't. And then there was probably labor that was siphoning off. They would fly up one of their guys sometimes. And there's certain things that can't be added back. And you have to really put your foot down to make sure that you let them know. Like no bank's going to accept it. And if the bank's not going to accept it, why would you? Right? There's no reason. And that's always something that you can land on. And if they're like, the bank's too conservative, I'm like, well, I appreciate that, but they're going to be funding me. And so I have to show them, and I need to be on the up and up. So it's unfortunate. Some sellers think that they're saving tax dollars, but really they're reducing their purchase price by a factor of 4 or 5, or in some cases, 8 to 10. So, you see all sorts of different scenarios, and it's unfortunate that that is a direction that many people go. So you're not seeing those add backs on my deals.
Another place I see that is unreported cash.
Yes.
And that's a tough one too. I literally just had one this week of, how do I handle, this company does, $4 million a year in revenue, but they only report 3 million because $1 million of it's cash. Mm-hmm. And like, how do we account for that? Can I, quality of earnings, if it's unreported, it's specifically because it's not generally not documented, right? If it's totally off the books, there's not even invoices that quality of earnings can really even identify. But the long and short of it is, if they're not booking it and they're not reporting it anywhere, but then turn around and want to be paid a multiple on that cash, that's a really tough conversation. And
undeposited cash is different than unreported
Correct.
cash.
Yes.
Correct.
So like I have a deal where they don't deposit their cash, because Kevin and I were talking about this. Sometimes the banks charge you like hundreds of dollars a month to deposit large amounts of cash. So I have this restaurant and they report everything. Their books are super clean, but they don't deposit the cash. So we had to disclose bank statements will be missing the cash. You'll see it in the POS and it all lines up, but they take the cash home because they didn't want to pay the money to the bank. And then they buy their groceries with cash and they go out with cash. But that's really how that works.
As a lawyer, I still hate it. But
Yeah. It's just what it is, you know. So
You can also go verify it too. It's, you know, if it's in a place, you can go to the safe and count the cash.
Correct.
And, you know, the cash exists. It doesn't just evaporate.
Right.
Yeah.
And for those of you that take investors, please, for the love of God, be careful what you do with cash. As
Yes.
the amount of searchers I hear about closing businesses, they raise 20% capital and whatever, and then start playing fast and loose of like, oh, I remodeled my house with profits out of the business, and I don't deposit cash, and the minute you take a dollar from a third party, you're going to get yourself sued eventually if you're not doing things very, very cleanly. But
and that feeds into tax as well, because tax in a lot of structures you have to make distributions in a certain way. And like if you take on S corporation, take on investors very specifically that are people, not corporations, and as corporation, you have to distribute in a way that is equitable based on the equity structure, or you will lose your S election. There's there's consequences to that. So be really careful with your corporate governance.
Picking back on that, so as an investor, I've invested personally in an S corp. I've invested in one of my LLCs. I've invested in my trust on one side, and then invested in the trust on the other side. So like we have like multiple scenarios. Like when we go see our accountant, like the first thing I sit down, I'm like, hi, sorry, great to see you. Like I'm always apologizing with all of our crazy stuff that we're doing, but know that and then like our trust had been created but not named. It was like he who has not been named. But anyway, so like the trust had been not named, and so we had to do like a tentative thing, and then so know that your investors have different needs and different structures, and you're going to have to answer to that or find the answer and lean on the professionals to, answer those questions. Yeah. I saw some hands go up. I don't know.
Yeah, I was going to say, we got a couple of minutes left, so ask us for more stories here. We'll run around the room real quick.
Hey everyone, it's Simon Reynolds. One thing I've noticed amongst the horror stories is that there are several like either family members or additional parties that have unrealistic expectations in terms of like so the 7 family members all about pushing the business out. Like, how are you getting these family members or outside individuals like on the same page so that the deal can actually be closed? Is this a common tactic? Like, what's worked about your experiences?
Direct communication.
Yeah.
You have to be direct, and people that have unrealistic expectations have to be told your expectations are unrealistic, and here is the reality. What's going to happen? You're going to lose the deal. You're going to do this. You have to have very frank conversations. It's like a CFO, fractional CFO, somebody that goes through diligence with somebody. You have to have some really difficult conversations. You can't be afraid to just say, "This is the way that it is." Like, look it up. Google it.
When there's that many parties involved, it can be a little bit difficult, and I'm not always successful in doing it. But when that happens and I'm on the sell side, I'm usually proactively telling the client, go solve that problem first, in terms of go collect all these 7 people, figure out who's going to be responsible for this deal and what the parameters are. Let's put a resolution in place that delegates authority to Jackie and John to go get the deal done on these parameters. And if ultimately we can't transact in those parameters and we need an exception, we'll come back. But that would be the ideal, particularly from the sell side perspective, is if you've got 7 different disaggregated family members, call a meeting before you're even listing the business. Hey, we're going to list, we're going to sell. What are we comfortable with? We're comfortable between $3.5 and $4 million. Not really between. No one's really going to hate extra money, but at least $3.5 million. XYZ terms, and if it's in those parameters, Jackie, knock yourself out. Let us know when it's done. That would be an ideal.
I try and manage my deals like I the same way I parent. I try and manage expectations. I try to under promise and over deliver. I try and look at it as a tour guide. like you don't yell at them or lose your cool. Like I always think about that. Like, would they rehire you for that parenting job or the deal making job next year? Like that's always how I'm like looking at it. When you have the family member deal, like I've had divorce parties, and like I have a good friend who brings me divorce cases, and one of the deals, they had this business that was unbelievable, and I could have sold it in 3 seconds. But I said, listen, let me ask you guys some questions. Do you trust each other? Okay, that's like,
Nope.
I know they said yes.
Liars.
No, I don't think they were. Because I first prefaced it with, is everybody wearing big boy and big girl panties? Because you had to break the ice, right? It's already uncomfortable. So sometimes I'll say something like mildly inappropriate to like break the ice, and everybody laughs. And it's, you know, it's how I do it. It's a little unconventional, but it works. And so I said that, and then I said, can you trust each other business-wise? Are you parting ways for, you know, you just don't enjoy each other's company? Like, would you still work with each other? And they said yes. And I instructed them what needed to be done, and they kept that business, and they still have that business. And my understanding is that they're both remarried, and they still have like, but not everybody can do that. So that communication is super vital. And like, I've also had times where people start fighting right away. So I'm like, okay, it was great. It was great meeting you. But, you know, you have to know what you can work with and manage those expectations.
Well, I know there's a lot of questions. We unfortunately probably only have time for one more, so you may have to sidebar here. But let's do right here because you're straight in my line of vision. Yeah. Yeah.
So one of the things that seems to be a theme is just how messy some of the accounting, the discrepancies in quality of earnings at the end of it. You mentioned that the lack of investments along the way in business a lot of times leads to that. What is it you see that they're not investing in along the way that leads to some of that messy accounting?
So really it's investing in the processes and systems that make the business run and therefore the accounting better. So, you know, if your QuickBooks is over here and you only look at it once a month and you use all the rules to post things to it, you're not really looking. You know, it's kind of, even CPAs get in this mentality, right? What are the books good for? Tax return. Everybody thinks tax return because, you know, my books are, that's what I do. The main value of the numbers and running your business is actually running your business. If you close your books every month, have a good process for knowing how much money you made on an accrual basis, not a cash basis. You know, we're going to talk a lot about cash basis in general for financing because how much your cash flow is going to drive everything. But accrual basis financials every single month, look at them, know your numbers, and run your business, you will have a much more successful business. So that's the investment I talk about, is just making sure that you're actually doing all the accounting and getting some value out of your numbers. But also investing in systems and process and all that. I called my company PPS Solutions because I couldn't think of any other more creative name on a Tuesday. People, process, systems. So it's what I believe in. Has to be in that order.
Greg, if I can comment real quick. One of the companies I sold, they had their inventory in one spreadsheet. They had their equipment in a separate area and did not run a structured depreciation schedule of any kind that was realistic on this planet or any other. Then they had payroll in another system, and then they had their QuickBooks. And like the QuickBooks, I didn't know what it did, but it was missing all these other elements because their systems didn't connect. So I see that. Right, and so that's when the books are a mess, and your systems you haven't invested, and that might need like another person, like a part-time CFO, to go in there and put those together, and it's painful. That's why people don't do it. It's painful.
Some of them are super simple, like, you know, with one common thing is people use their bank statements to kind of clear the QuickBooks, right? So when you do your payroll, for example, your paychecks come in, your direct deposits, and you put them to salaries. And then the tax payment, which actually includes a lot of pay because most, you know, our W-2 people are paying the taxes, they put that to tax expense. It's not wrong, but it looks way wrong. It looks like your taxes are you know, 50% of your payroll when they're really not. So just, you know, running simple books, and you can always tell somebody that's close to a good system by that entry in particular. But, you know,
that's a good point.
Just reconcile the bank. Yeah. That's the minimum baseline for, you know, for investment, I think.
Yeah, sorry we're out of time, but grab us. Happy to always tell more stories. Sorry we only had time for a handful of stories there, but hopefully you learned something. And yeah, we'll turn around here real quick and get the next session going in a few.